So thank you very much, the panel. So just move on to the next panel, IFR implementation issue, but IFRS 17. As you know, that was recently endorsed and huge impact on our industry, insurance, as well as our regulation. So this panel enlightened us of the impact of IFRS 17, and also we can learn how it's linked with our supervisory standards and so on. So Markus, of course, is the leading person of this project. He is the chair of our accounting committee, and naturally very much deeply involved in this IFRS initiative. Thank you.
Thank you, Yoshi, for the short introduction. So it's a great pleasure to be here today, and we are lucky. We are lucky because we got the final standard on IFRS 17 by end of May. So this is quite a new standard, and we have we can feel very privileged that we have Izabela, Ruta, and Darrel Scott here from the ISB taking us through the main points of the new standard. I very much look forward to this exercise because you have to realize that project started in 2001, and 16 years later we have a standard and we have about 40 minutes for the presentation. I don't know what was the bigger achievement, to summarize this in 40 minutes or to finalize the standard. Having said this, I'd like to introduce both of them. I start with Darrel, being a little impolite to Izabela. But Darrel is board member since 2010 with the IASB. Before, he was a member of Ifrs, the interpretation committee, and also he was in the Standard Advisory Council. Before that, he worked for a financial institution in South Africa, and he has also knowledge about insights in the Basel regulatory process. Having said this, I move over to Izabela. Izabela is the technical manager of this project, and we had a lot of contact the last 5 years, I would say, and we are in close contact. So I immediately hand now over the word to both of them, and I wish you some insights in a very interesting project.
Thanks very much, Markus. Can I speak with the label? Perfect. Thanks very much, and good morning, everybody. So yeah, I think it's a very good point. This project has, in fact, taken even longer than you thought, because it started in 1997, and it was actually handed over from the old IASC to the ISB to take the project from there further. So this really is a project that's been a long time in germination, and I think we were very, very happy to see it out the door a couple of weeks ago. As Markus says, we're not going to go into a lot of detail now. This is really to just give you a high-level insight into it. We've got about 2 minutes per year of development, so we'll sort of take it on that basis. And we won't be testing you on any of this afterwards. We'll sort of work into it slowly. We want to cover a couple of things: why the standard was developed, how it actually operates, and then draw a few parallels between what you would see in an IFRS 17 set of financial statements versus what you are used to seeing in the solvency space, in the regulatory space, and under our old IFRS 4, the previous accounting standard that was in place. The first question, though, is why? Why did we need to develop a standard for insurance? People know we've had an existing standard. For many of you, firstly, that know about the IFRS world, IFRS covers a number of different jurisdictions. It's a common accounting language that's used across all of these jurisdictions. In particular, we've done a study ourselves because until recently we didn't know who was using IFRS. And in that context, of the 150 countries we've spoken to, 126 currently require or permit IFRSs for insurance companies. But it goes a little bit beyond that, because within the leftover numbers, the 24 that split the difference, there are a number of countries. China is one of them, and I heard a Chinese speaker from China earlier. China is one of the countries that, although they have not adopted IFRS, they have converged their standards predominantly with IFRS. And so essentially, the new insurance standard will probably be adopted as we have written it at the ISB, into Chinese accounting standards. We expect something similar to happen in India, which is another jurisdiction that's in those 24. So this is a standard that is likely to be applied across the world, across a very big proportion of the world. The important thing for us then is that this is a standard then that will be consistent for everybody who uses IFRS. And that talks to the big difference that IFRS 17, the new insurance standard, has with IFRS 4, the old insurance standard. It improves comparability because the previous version of our accounting, IFRS 4, essentially grandfathered old practices. It said whatever you were doing before you adopted IFRS, you could now continue to do. And by grandfathering existing practice, it simply allowed a whole bunch of incomparable things to continue in the financial statements of insurance companies. And it meant that any comparability created by everybody using IFRS was essentially illusionary. It was pretend. And so you saw a number of different practices that continue to exist. So one of the big things we see IFRS 17 introducing is comparability in the way insurers across the world account for the insurance activities. A consistent framework. The other important thing about it is that we've used principles in IFRS 17 that are consistent with the other IFRSs out there. Because IFRS 4 allowed a whole bunch of different things, essentially people were doing things not just differently from other insurers, but also differently from other industries. So you weren't thinking the same way. IFRS 17 corrects for that by aligning the practice of accounting for insurance with the accounting in other industries. But of course, this is not just an exercise in comparability. We don't want to just get people accounting the same. We also wanted to make sure that we achieved better accounting. And one of the reasons why the slides are in this order is that the better accounting, because the fact that every country had a different starting point, better accounting doesn't mean that everybody's on the same journey. So for many countries, what it'll mean is more up-to-date reporting, reporting current events, updating forecasts, better measurement of profitability. For some jurisdictions, they do that already, although there are a limited number of them. But the big change is to move everybody up to this level, where what we're now doing is talking about current accounting, current reporting, reporting and updating your forecast for what's happening in the world right now. And then we'll talk about this a little bit more in a few minutes, but profitability reporting for insurance entities will now be consistent across all of these jurisdictions. And that's one of the big differences, both consistency, but also how the profitability is reported. When do you actually make a profit when you're in the insurance business? And IFRS 17 goes a long way, or a big part of the objective of introducing IFRS 17 is to report profitability in line with when you provide the underlying services. Now, one big question, this is a question that we hear quite often in jurisdictions that have adopted regulatory frameworks similar to Solvency II, regulatory frameworks that are brand new, that have just been introduced across a whole jurisdiction where everybody's already had to change once. And we frequently get the question, well, why do we need an accounting framework and a regulatory framework? What is the difference? Why do we need both? And I think this is really important because we've seen the same question come up in the banking environment when we introduced IFRS 9. It's clearly relevant in this environment where you have, again, highly regulated sets of numbers being put out by insurers. Why do you also need an accounting standard? And the reason predominantly is that the objectives of a regulatory framework are different to the objectives for an accounting framework. Regulation is about assessing whether or not a company will have sufficient capital in the bank, sufficient capital provided, in order to cope with future events, in order to cope with future shocks. It's primarily a conservative approach to the understanding the business. In the banking world, we'll talk about wanting banks to put away money during their good years so the money is available for the bad years. So it's about sufficiently providing for these things, having sufficient capital available. Accounting is a completely different thing. It's about the measurement of the value of an entity at a point in time and the understanding of how that value of that entity will change over time. So from an accounting perspective, we want to represent at the first instance the value of the company right now. So all its warts, all its good news, all of its bad news taken into account at a point in time. And then we want to give people information to assess, to understand what the trends are likely to be in the growth of the value of the company over time. So profitability is important for accounting. Current value, warts and all, is important for accounting. The regulatory view is a slightly different view, is looking for slightly different information. All right, so what is in the insurance model? What is the insurance model about? I think the starting point of understanding the insurance model is that we define insurance differently to the way a regulator may define insurance. Typically in the regulatory environment, insurance is a product issued by an insurance company. So you start with the entity, and the products that entity issues, if it's an insurer, are insurance products. IFRS is a different way of thinking about it. We look at individual transactions and say an insurance contract is a contract in which risk is transferred from one party to another, and in terms of which the second party will compensate the first party for and to the extent that the first party incurs a loss. So that is our definition of an insurance contract, and then that definition goes to everybody who issues that type of contract. So a number of people outside of the pure insurance world may well issue insurance contracts as we define it. And equally, insurance companies may well have products on their books that are not defined as insurance. And so they would need to use other standards for those contracts that don't fall within the definition. The positive here is that this is not a definition that's changed, so this is something the companies are already used to, that they'll be applying as they've applied in the past. What does the model actually look like? Well, the model has got, firstly, its core requirements, and hopefully there's a couple of very obvious things on here that everybody would agree makes general sense in terms of the way you think about the economics of insurance. We measure the present value of the probability-weighted future expected cash flows. So probability-weighted, taking account of the time value of money as an unbiased measure. So you're not conservative, you're not optimistic, it has to be an unbiased view of those future cash flows. You adjust those future cash flows for the effect of risk. So the risk adjustment is a separate, explicit adjustment that overlays the unbiased cash flows. That gives you what we call the fulfillment cash flows, what is very often similar to some of the terms that would be used by an insurance regulator in defining the best estimate liability of the company. It's the starting point of our calculation. But then we go a step further and we say that for most insurance products that you sell, when you do that determination, your expectation is a net cash inflow. The money I'm going to receive hopefully exceeds the money I'm going to pay out. It's a profitable contract. That profit, that day one number that you recognize, from an accounting perspective, is unearned because you have not yet conducted the activity that you need to. And so we take unearned profit and we call it CSM, and we say we will park CSM for the moment. We'll put CSM in a bucket. And you can only take CSM out of the bucket over time as you earn the profit, as you earn and do the work that's involved in that contract. In this case, as you provide coverage. So the objective of IFRS here is to say, well, let's first, as I say, determine what my liability is, and then take whatever my unearned profit is and put it in the bucket. Each year, I remeasure my liability, and some of the adjustments in my liability, the adjustments that relate to the future that hasn't happened yet, I can use my bucket to absorb them. So if my profit has gone up, I just put more profit into the bucket. If my profits have gone down, if my profitability of the contract has gone down, if the cash flows are adverse, cash flow adjustments, I can take profitability out of the bucket. I use the bucket to absorb variations in profit over time. But the important thing is, because it's a bucket, when the bucket's empty, the bucket's empty. If there's nothing left in the bucket, then I take the losses immediately. We call those onerous contracts. Onerous contracts are recorded in the profit and loss as soon as they occur. It's an important part of the model, and it's because we believe that people want to know when there is nothing left in the bucket. The IFRS 17 model is also adapted for specific product types. So we start with that core model I've just spoken about, and then we have specific adaptations to cover contracts with direct participation. In other words, where the policyholder directly participates in an identifiable underlying pool of assets. We have adaptations to the core model to deal with reinsurance and the way reinsurance is accounted for in an insurer. and to deal with investments in discretionary participation funds. And then finally, underlaying the bottom of this, we have a simplification, which is our premium allocation approach. So I mentioned earlier that this is similar to the Solvency II type of environment, similar to any updated regulatory type environment. And this slide just shows where the similarities are. Present value of cash flows is measured in the same way. It's a consistent assumption in the way we think about the present value of cash flows in a regulatory environment and accounting environment. Both models have a risk adjustment or a risk margin, as we would call it in risk adjustment, we call it in IFRS, risk margin as it's referred to in Solvency II. The only difference is that a Solvency II environment typically takes all of the expected profit immediately to equity or to a capital measure. Under IFRS, because we don't recognize all of the profit immediately, that profit release is delayed over the life of the transaction. And so you have this mechanism for recognizing profit over time. That, in a nutshell, is the model. I'm going to hand over to Izza, who's going to talk to you a little bit about how that model then will reflect in the type of financial statements you actually see. And then we'll talk a little bit about the implementation support that we are giving.
Thank you very much, Darrel. So I'm going to walk you through the balance sheet, profit or loss statement, OCI. I'm going to talk a little bit also about disclosure. We have quite a rich package of disclosure with a lot of useful information, especially for investors. And then I'm going to walk you through a little bit about our plans. So we published the standard, but obviously we're just not sitting and waiting for the questions, although this is on the side we are doing as well. We're actually producing a lot of information, a lot of hopefully useful materials for you, so it's easier to apply IFRS 17. So balance sheet. I think what I wanted to highlight here is the simplicity of IFRS 17 presentation. So this is an example, obviously, as Darrel was saying, IFRS 4 in essence permits a lot of different things, and therefore we will see in different jurisdictions, different contracts, we will see different presentations, a lot of different line items. Here it is an example. Obviously it will look differently for different entities, but I wanted to highlight that actually there is a lot of different line items. So the insurance contracts is put in a lot of different line items, and it's quite difficult to understand what is going where and why. So you can see premiums receivable, you can see deferred acquisition costs. That was a lot of discussions about that, and a lot of confusion for investors as well. Policy loans, unearned premium, insurance contract liabilities. That is going to be simplified under IFRS 17. So in essence, what IFRS 17 is doing, it's considering insurance contracts as a bundle of rights and obligations. And this bundle of rights and obligations can be in an asset position or in a liability position. In an asset position, it can be, for example, when an entity pays acquisition costs up front, and there is anything else is not happening. And therefore, that contract will likely to be an asset position. But we know quite often, or more often than not, it will be an insurance contract liability. We ask people to consider those positions separately and show them separately on the balance sheet. The other thing that the IFRS 17 requires to be put separately is the reinsurance contract. Again, those can be in an asset position or in a liability position. We ask them to put separately from each other, but also separately from insurance contracts. But I think more revolutionary change is actually in the statement of financial performance. And I think the first thing I would like to stress here, that Darrel touched on it as well, it's going to be consistent for all insurance contracts. So there will be no difference what kind of model you're applying, what kind of contracts you are. All of it will fit into one presentation, which hopefully will provide rich information, comparable information for investors as well. So again, there is an example of IFRS 4. This is just an example. There could be different line items for different contracts. But what I want us to stress here in this slide is that there is a first line quite often in the statement of financial performance, premiums. That line item is often not comparable. There are different measurements of premiums. For example, there could be something on a cash-like basis, like premiums due. Sometimes it could be all the expected cash inflows for the contracts at inception over the life of the contract. It can be also an earned premium approach, which is similar to revenue idea. All of them could be bundled within one line item, which again could be confusing and quite difficult to understand and compare for the investors. The other quite important line item which I would like to highlight here is the change in insurance contract liabilities. This line item can be a quite significant number, but again quite difficult to understand because in essence it includes a lot of different ideas. There could be interest accretion, there could be change in estimates within this line item. Sometimes entities disclose some detailed information about that, but it is not done consistently, and therefore for investors it's quite difficult to pick up what this number actually means. So what IFRS 17 requires is, again, a consistent presentation with richer information. So starting, what I would like to highlight is that, first of all, it explains two different drivers of insurance profitability or a loss-making, if that's the case. First of all is the insurance service result. And in essence, what that line item is saying is how well an entity is making profit from insurance activities, which is underwriting. So here it will be insurance revenue, incurred claims, all other expenses as well. Now, what the IFRS 17 will require further is to separate all the profit from the investment activities, which will be insurance finance expenses in profit or loss in OCI, which I will touch in a minute. But again, this is something that, combined with investment income, will show how well an entity is making money from investment premiums, which are usually taken up front and then invested to get some profit on it. Now, because of the different measurement aspects of financial assets, as we know, IFRS 9 will require fair value through profit or loss, amortized cost, but also the use of OCI. An entity will be able to choose OCI to put some changes in the discount rate. In essence, to be able to better match what is happening on the asset side in terms of the accounting. In terms of the disclosures, again, because it's a quite complex model, there is a lot of estimates involved in it. We will have quite a rich information package in terms of the disclosures. We separated those disclosures, as you can see, in 3 columns. First column is about quantitative disclosures. So it's in essence explaining how the numbers are flowing and how the numbers are being fed into the liability measurements. I will show you actually 2 examples of those disclosures in a second, so I will not go into details right now. The other one is about judgments. And this is mostly coming from the liability measurements. Because an entity will need to use a lot of judgments, it's quite important for investors or other users of financial statement to understand what judgments were made and how sensitive is the liability measurements in terms of the use of those judgments or changes in those judgments. So an entity will need to explain those judgments made. And the last one is the information about risk of insurance contracts. And this package of disclosures is actually quite similar to what we have in IFRS 4 today. It is also going to be similar to the disclosures that are currently required for financial assets. So let's move to the reconciliation. I think this is quite interesting and full, rich package of different information. We will have 2 reconciliations of the amounts that are being reported in the balance sheet. The first reconciliation, in essence, is going to provide a lot of information about profitability. So as you can see, we will have here the line items that Darrel was talking about. So a lot of that information is actually coming from the liability measurement. But not all the contracts will use that main liability measurements, so this disclosure will not be provided for all of the contract. Darrel touched a little bit about different measurements, so we will have something that is called a premium allocation approach, which is quite similar to currently used unearned premium approach. For those amounts, we actually do not ask explicitly for those line items, and therefore those contracts will be exempted from those disclosures. However, we have the other reconciliation, and that reconciliation will be provided for all insurance contracts. And in essence, what that reconciliation will do, it will show how the amounts that are being reported in the balance sheet, which is again just one line item, is being transferred to all this rich information and different line items in the profit or loss. I will go into a little bit more details of those reconciliations right now. So this example is coming from the effects analysis. Effects analysis is a quite useful and rich, I think, package of the information of what are the likely effects of applying IFRS 17. So if you want to dive into more details of this disclosure, it's quite useful to go back to the effects analysis. And this is just a summarized disclosure just for the purpose of this presentation. But I think it still highlights quite a few useful features of IFRS 17. So in essence, it's separating the changes that are resulted from the liability measurement into three packages. I will start maybe with the current service and past service. So an entity will show in the profit or loss the information that is related to the current services provided in the period. And that will come mostly from the release of the contractual service margin. So this is the unearned profit that Darrel was talking about. It will also come from the release from risk, which will also go through profitability of the current period. The other line items, as you can see here, is the past service adjustments to the claims. So this is all the changes in estimates that the entity will do after the claim is being incurred, but before it is going to be paid. So if there is any uncertainty about that and there is a change in estimates, that will also flow directly through profit or loss in the current period. But there is a third bucket of the changes in estimates, which is related to future services. And I think this actually line item is mostly packed, and you can see quite a lot of information in the effects analysis being disaggregated. Because in essence, this line item actually highlights two different types of information. First of all, it is about the contracts that are being recognized in the current period. And for those contracts, the estimates of the present value of future cash flows and risk adjustments and the contractual service margin, they all together would balance each other, and the effect on the liability after all will be zero. However, if the contract is loss-making, there will be a number at the end because it will not be offset by contractual service margin, and that loss will be recognized again through profit or loss directly in the current period. In this line item, there is additional feature. So if there is a change in estimates in the current period to contracts that were being recognized in the past periods, but those changes are related to future services, we don't want to recognize them straight away. And as Darrel was pointing out, we have this buffer, which is the contractual service margin, which is in essence the unearned profit that is related to the future periods. We will store those changes for a while, and we will recognize those changes in the future. Again, it will balance it out within this line item, and you will not see the change in the liability at the end of the period. The other reconciliation, as I was saying before, in essence, is showing how the amounts in the balance sheets are being transferred to profit or loss statement. And I think quite important feature which I wanted to highlight here is the insurance contract revenue. That can be quite a new idea for a lot of live business, but it is actually an idea that is already incorporated in unearned premium approach. And on a high level, at least for me, it's simple if I think about it in the same context. The only difference is that for unearned premium, the revenue recognized is driving the balance sheet amount. for the main measurement, for the core measurement, we've got the balance sheet calculation, and from that balance sheet calculation, we will derive revenue. But in essence, it's quite a similar idea. The other thing which I wanted to highlight on the slide is the information about cash flows. We actually spent quite a lot of time with investors to talk about what kind of measures of the activities the investors would like to see. And they told us that they would like to see cash flows being the kind of important metric for them to understand what is happening in the organization. And in this reconciliation, you can see information about cash flows, about premiums received, claims and benefits, and we ask separately for information about acquisition cash flows because, again, investors told us that this is quite an important metric for them. Those two reconciliations, I would like to highlight. We, as an IFRS, doesn't prescribe normally how the disclosure need to look like. So this is just the staff idea of how an entity could interpret the standard, but there is no one way of doing it. So again, this is just an example. Okay, so I will spend a few minutes to talk to you about what we are doing right now, how we are trying to help with implementation, and how we are trying to prepare people for the implementation efforts. One of the things that we are doing is actually coming to the events like that and then talk to people, try to understand what they are thinking about, but also to try to explain how the IFRS 17 is working. So once we publish the standard, it's not only just one book. It's not only one standard that we are published. We are trying to be helpful, and we are actually publishing a lot of supporting material. And as you can see with the IFRS 17, which includes application guidance in itself, we also, by adding basis for conclusions, which is explaining what was the board's rationale for making decisions. It's also explaining what kind of routes we already explored, but for some reason we decided to abandon and go to a different direction. We've got a package of illustrative examples which are trying to explain in a very simplistic way, simple numbers, the mechanics of how to apply some of the requirements. But we also have a lot of additional materials. We are trying to publish webcasts, podcasts. There is possibility for downloading slides, which might be quite useful for example, when the Chief of Accounting is trying to explain the IFRS 17 to the Board of Directors. We also have some targeted materials. We've got materials for investors who are not familiar with a lot of accounting jargon. We've got materials for regulators and national standard setters as well. So this is the timeline. This is how we think about approaching different issues within the 3.5, in essence, time frame before the standard is being effective. So what we're doing right now, we are trying to focus on educational materials. So as people are reading the standard and preparing for the implementation, and we are waiting for the questions, we are trying to focus on supporting materials, articles, webinars, and the conferences like that. We are planning to introduce the transition resource group. This is something that we've done for other projects already. So we've got some learning points, and we are trying to use those learning points as much as possible. There is a call for nomination until the end of July. We will spend some time reviewing that. And we think sometime by the end of the year, we're hoping to start the meetings. Once we will, of course, have some questions, so people start thinking about implementation and some more detailed questions. We are thinking to spend probably next year mostly on the TRG, but also if there are some questions that could be answered in a more helpful way in education materials, we might produce them as well. So we will be thinking about a range of different activities depending on the type of questions. And then I think around late 19 and 20, we will try to make it a more of a calm period, so people can actually start stepping their foot on how to actually implement. We don't want to introduce too many additional guidance, because this is what we found with the previous projects. This was quite disruptive, and people said that they need to have a grasp of everything that has happened before they actually start implementing the standard. So this is what we prepared for now, but I think now we will open to any questions that you might have. I think if you have the printed package of the materials, we've actually added quite a lot of additional slides, and this is mostly for your information, but if there is any question that might be related to this slide, we might just skip down ahead and just talk a little bit more about that. Thank you.
So I would like to open now for your questions. Okay, I see there are a lot, so I'll sit down and start right away.
Thank you very much. What could SOF 7 as a house we much welcome the upcoming standard, especially with regards to transparency, and also published our views on that already. Two questions, if I may. One is around the set of assumptions and expectations needed, as you just explained. I have the feeling it's a bit more than we have in the IFRS 4. How to ensure the consistent application and to hinder the industry kind of shooting themselves in the foot, as we saw with the mark consistent embedded value, where we never saw two disclosures which really have been consistent, which is number one. And number two is obviously on the former proposal in 2011 on the IFRS 4 phase 2 back then. There has been an underlying trend, obviously, on convergence with US GAAP, which obviously might have answered the question when you had the slide on the global application of the standard. Is anything of this still left? Thank you.
Shall I answer?
Yeah, of course.
So I think on the first question, the IFRS 17 has taken a principle-based approach, as I think you rightly point out, to a lot of the assumptions. You're correct, there are a lot of really important assumptions around future cash flows, around discount rates that you use, and etc. What we've done with 17 is to have a fairly clear objective of what you are trying to achieve with those, and then to Iz's point earlier, to require quite a lot of disclosure about the judgments you make. And we think what that does is introduces an element of market discipline. So users will be able to see the types of assumptions that entities are making and judge their basis, judge the accuracy or the outcome of their numbers on those assumptions that they're making. And we think that market discipline will drive a certain amount of consistency within markets amongst these types of things. And we've seen similar things already starting to happen in IFRS 9 with the impairment modeling, which has got a similar basis. In the context of alignments or convergence with the FASB, I think we did start out this project as a joint project. We very quickly discovered that the two boards had clearly different objectives. I mentioned how poor a standard, if you like, IFRS 4 was, because it allowed such diverse practices. The US is in a very different situation in that they already have existing accounting standards that are in many circumstances seen to work. And so what they've done instead is taken a targeted improvement process. But the work that they're undertaking right now on those targeted improvements actually moves them quite close to where the IASB is. And we'll continue to interact with them over time, and if we can help them, or if they can help us, we'll certainly take that into consideration.
Thank you.
Hi, my name is Bill Schweigler. I work for the Aegon organization, and Aegon has most of its business in the United States, so there's probably no sort of U.S. operating company more impacted by IFRS 17 than Aegon Transamerica. I do want to congratulate you, by the way, on putting out the standard. I'm already suffering a little bit from the withdrawal from the monthly meetings that I've been following for many years. So congratulations to you on that. What I think we observe in our organization as we read the standard is that it's sort of not written for the U.S. market. So there's a particular product class. I've seen three vastly different interpretations how the various models apply to that class of products. And so, and this sort of is, even before you get to the questions, what are the cash flows, risk neutral or real world? What's the discount rate? What's the risk adjustment? I personally expect, given sort of all these uncertainties, I personally expect kind of vast differences in how companies apply what's written to at least US products and probably products in other markets as well. So my question is, it relates to some of the post-promulgation work that you're doing. What's the threshold that's used for issuing kind of formal interpretation guidance or even reopening the standard? What is used? What's the hurdle that has to be cleared for those processes to occur? Thanks.
So if I take a step back on that question and start with the fact that from an ISB perspective, because it is a principle-based standard, and because all of our standards are principle-based, Isa mentioned that we've been through this experience a few times, and there are a couple of learning points we pick up. And I think that's exactly what we'd expect to see happen here. And one of the big things that come with those learning points is what I would call a sort of a socialization of the discussion. The more people discuss it, the more you tend to find a consensus emerges around the correct way to interpret things. And the ISB, because of the principle-based, expects to have those discussions happen and expects to see some consensus emerge on at least some of the topics over time. You mentioned the US products, and I think although the US products in some ways are unique, I think the problem you're discussing is not. One of the big issues, or one of the big challenges for this project, was the fact that every jurisdiction has got nuances on the products they produce, and those nuances create a problem with the way the standard or the judgments that are applied. And deliberately what the ISB did with this was to keep that judgment open so as to encompass all of these different product types. Now where the TRG then comes into play is what we want to do is give people a little bit of time to spend time talking about these, working through some of the issues, seeing how much they can filter out by solving themselves. We also are going to encourage people during the course of the process to understand that this is principle-based. We're not trying to write a rule. The TRG is certainly not going to say, well, I have this specific product, what should I do with it? Rather, what the TRG is going to try and say is, here are the type of drivers you might want to think about. So the starting point for us in providing a TRG is to provide a forum in which these types of discussions, these types of judgments can be explored in public, so that other people can hear that discussion, hear that deliberation, and go away and apply that sort of thought methodology. We don't see a need at the moment that we would need to make changes to the standard. Clearly, we wouldn't have issued it if there were things that we felt weren't finished. We also don't think that there's a need for interpretation. And one of the things that I've been cautioning people when people ask me the question is, be careful what you ask for. The standard is very often left at a principle level to allow an interpretation to happen. That interpretation in many circumstances, that judgment in many circumstances, is to allow businesses to present their business the way they manage it. And you mentioned risk-free modeling as one example of the way that you might manage your underlying risk. That's left in the standard as a way that you can consider how you would model in order to achieve the objective. A question that comes to the ISB, or a question that goes to the Interpretation Committee, forces the ISB or the Interpretation Committee to narrow that view. Arguably, from the ISB perspective, that means that we don't achieve the objective we set out to achieve. And we think in some circumstances, if you don't like the answer you get, it doesn't achieve what you're looking to do to answer the question. But as I say, the idea here would be, as the first instance, is to have the judgmental type discussions in a public forum so people can learn from learn how to think about the judgments rather than learn how to answer their specific question for their specific product.
Hello, my name is Makoto Kumo. I'm glad to see you again. So for those people who are coming to IAIS might not believe it, but I spend more time on accounting than regulation. And at least the two speakers of this panel can confirm that. So since the English-speaking Japanese are limited in life insurance sector, we have to deal with anything related with common language, so to speak. So when I was working in London, I encountered the Sir David Tweedy, who was the first chairman of ISB, and he was like, "Oh, Mark, you're still coming to the board meeting, isn't it amazing?" Of course I do, because I have been working on this topic for 20 years. Precisely speaking, I started discussion with Mr. Wayne Upton in 1995 when he was still at the FSB. And then I have been working on this and delivering some messages, and I still remember that I was a panelist in the IAIS annual conference in Germany following the September 11th event. And using data from the stock market on these days, I described the issue of short-term volatility. And I tried to describe how the one-size-fits-all model would not work for insurance accounting, and it should be principle-based. It may sound a bit familiar. So I told you that we have a long-term vision. So I will do the same thing. I will say the same thing for the next 10 years whenever you come up with the interpretation, implementation, and possible revision of the standards. Maybe a little bit less because I may eventually retire and perform in the Broadway as an actor or something. So let me get to my point. So in the APFF project that I just talked about yesterday, we are also working on accounting issues. Unlike in Europe and US, the solvency assessment is defined independently either by Solvency II or principle, like a statutory accounting principle. Many of the Asia-Pacific economies are using IFRS as a basis for their solvency assessment, including capital requirements. So the impact of the replacement of the IFRS 4 by IFRS 17 will be immediate and direct. So we are trying to help those selected APEC economies in terms of implementation by identifying any issues of implementation and providing the potential support on this. And more importantly, we are planning to hold the APFF roundtable in Hong Kong, either on the October 30th or October 31st in Hong Kong. Idea is that for those people who are coming to IAIS annual conference in Kuala Lumpur, they can probably transit and stop over in Hong Kong to spend one day with us to discuss IFRS 17 and its implementation. This is the idea. In collaboration with Deloitte China and also the Hong Kong University of Science and Technology. And the good news is that Darrel is kind enough to confirm to come to our event as a keynote speaker as well as a panelist. So we have a direct dialogue between the ISB and experts in the region. So I must tell you, Darrel, so you are the hope for us. You are the most familiar with insurance contracts, also open-minded to listen to us. Only problem is that his first name is difficult to pronounce for Japanese because we don't know the distinction between L and R. Darrel is kind of hard. But I'm trying to make best efforts because this distinction is absolutely important because long-term insurance contracts should not be made wrong term by accounting standards. Let me make it a question. In order to prepare for this event, what kind of information you want to hear from us on your side? We still have 4 months to prepare. Thank you.
So, Mac, let me pick up a couple of issues that I think you raised there that are quite important. The first is, you are right, one of the oddities of the length of the project that we've had is some of the observers have been observing for longer than any of us have been working on the project. The other thing is that I've had a number of requests from people asking us to delay the project for a year or two so that they can retire first. So sorry we missed on that deadline. The other issue that you raised that I think is really important in the context of supervisors is those supervisors that use IFRS as the starting point for their determination. The IFRS transition reflects what our philosophy is with the IFRS, which is that we want the standards at the first reporting date to present the same picture they will always present of your business. Up-to-date current measurement reflecting the capital or the equity that you have available at that date. The transitioning in IFRS is in no manner intended to soften the blow or extend the effect of IFRS into later periods. It simply helps you from an operational perspective, data gathering, in terms of how much historic data you have to collect. That means that if you are using IFRS as the starting point for your capital determination, you may want to consider some sort of phasing mechanism to make sure that there's not a day one immediate effect on the capital adequacy or the ability of the business from a capital perspective to continue its activities. To your question, I think it would probably come back to something Isa said when we talked about the TRG. We are openly talking to everybody we can right now, trying to understand what the issues are, where the issues are coming from, what people's concerns are. So I think in the broader context, if you have issues, if there's anything that comes up that you're unsure about, particularly from a supervisory perspective, we have set up a website specifically that deals with insurance. We set up a web address or an email address where you can drop these queries. And what that will help us do is develop a map, if you like, of where issues exist that we can actually look at.
So I'm conscious of time. We take one more question.
Thank you.
You snuck in, Peter.
Hi, Darrel. My question is similar to Max. He's a hard act to follow, but you had a very interesting slide conceptually showing the liability on the IFRS 17 basis with that on the Solvency II basis. That slide could just as well have said Solvency II / ICS on it because the concept is the same. The differences, of course, come in the details of how you do the fulfillment cash flows and the risk margin. My question is that do you see the IFRS 17 as a useful basis, and I also asked this of the IAIS representative as well, as a useful basis for the ICS going forward, taking out the contractual service margin, of course?
So let me start by answering it from a purely IFRS perspective, and then I might leave it to other experts in the field to answer the more specific part of it. So
I'm actually asking it from an IAS perspective.
okay, well then
as
I will
No,
in fact
but-
stop there, right
but that
there,
as
leave
well.
it to...
No, please.
I was going to say, so clearly the starting point for the ISB in measuring fulfillment cash flows was to portray, as I mentioned, firstly, an unbiased view of what the future cash flows are forecast at any point in time, adjusted for time value of money, adjusted for the risk that the entity perceives to be in those cash flows. We thought that the three of those combine a very good forward-looking view, economic view of an entity's balance sheet. Now, the problem is and the next step of that then comes into the issues that I discussed in the same slides. That is a starting point for financial reporting because it helps you understand the prospective future situation for the business. But clearly, from a regulatory perspective, there are other considerations that then come into play. And I think whether you start from the same point or whether you develop something in parallel to that point is then a question we would probably pass back to the regulators.
So I guess I'm the one who is to answer the question. I could make my life easy and say time is up, but let me try to answer the question, and that implicitly answers your question. It's a try I do take. We recognize that we have different accounting standards all over the world, and we got a final standard with IFRS 17 in May. So coming from the opposite side, for us as an organization to completely ignore a new accounting standard would be a false treatment. So what we are doing in the future, I cannot answer your question, but what we are doing is we are analyzing the different standards across the world. And it's pure coincidence that Darrel put on his slide Solvency II. I'm not happy about it. Because we are an international organization, having said that, and it does not preempt any discussion. So basically, that's the answer for now.
That's what I thought.
So I would like to thank you very much, and I would like to thank Isa and Darrel taking time and doing that exercise and summarizing the standards. Thank you very much.
So again, excellent panel. Thank you very much. We learned a lot about IFRS 17, and Markus concluded that we are trying to take into account, and I know that the next few months, our accounting committee working hard to learn and how to make best use of this accounting development. So now there is one announcement. There is somebody called Eric left his iPad. I think it's very important stuff. So left in iPad in chapel last night. So if you are Eric and you left iPad in chapel, please let me know. Okay. So we will meet again in 11:30. So just could you come a bit short break? So come back in 20 minutes. Thank you.